Good morning and welcome to Fidelity Connect. I'm Pamela Ritchie. You know, just 2 months ago, the S&P 500 closed at an all-time high. Now the index is being flung through volatility, with it getting down close to 20% and dipping into bear market territory. Now, as investors wait with bated breath, does our next guest see this as a short-term correction or the beginning of something bigger? Joining us now to unpack the markets and what the moves may mean for you and your clients is Fidelity Director of Global Macro, Jurrien Timmer. Hi, Jurrien, great to see you. Thank you for joining us. We really need a dose of what you have to share. One of the questions floating around right now is whether it's oversold enough for some version of a conviction stepping in. What do you say?
Yeah, so let's kind of run through the action a little bit. Let's start with slide one. So as of this morning, the market did cross over into the 20% decline mark. As of last Friday, it was down 17.5. Almost seemed kind of predictable that traders would at least test the waters of that bear market territory. And, we just need to emphasize that, when we think about bear markets, 20% is kind of the threshold that we all use in the business. But we've had we've had a number of 20% declines that would technically be called bear markets, but that reversed very quickly. And before you knew it, you were at new all-time highs. So, the word bear market gets kind of thrown around a little bit, but we have to start somewhere. And so we did cross over into the 20% mark. And just to go to slide 6 to show you all the declines of at least 10% going back in history, that's what it looks like. And sometimes they happen slowly, sometimes they happen fast. This one, of course, is very, very fast. It took only a few weeks to get to down 20%. But the question, of course, is this going to continue? Will the market find its footing? Is it oversold enough to have conviction to rebalance into the weakness? And of course, this is where I come in, and this is where I try to guide my colleagues, including on the Canadian asset allocation side. And so we look at history, right? And so if we go to slide 4, we look at technical measures, right? We look at sentiment, and sentiment is very cautious, and it's probably more cautious now than it was a week ago. But even a week ago, it was cautious. But we look at other measures. So in this chart, I show the percentage of stocks in the S&P 500 that are below that are making new 52-week lows. And if you remember, we were just getting started back during the COVID days. I'm not sure if the show was live yet back then, but during COVID in March of 2020,
it was live. It went live during those dark days when we started into lockdown. Yeah.
But that particular measure, you can see it like the down 82% there in the bottom right of the chart, reached a historically oversold level. And that indicator, more than any other indicator that I looked at the time, gave me the conviction that this thing was so sold out that unless we were repeating the Great Depression, that was one of those generational signals that only happens, every, 20 or 30 years or so. So the question is, where are we today? And as you can see there, the number is at minus 29%, which is not even close to that number. And that doesn't mean that that we have to get to that number in order to have a bottom. But my point is that the kind of statistics we're seeing are consistent with a sort of moderate oversold level for moderate declines, but it's not a severe decline. And that makes sense, of course, because during COVID, the market was down 35% in like under 4 weeks. Today, we're down, let's say 20% in a similar time, but that 20 is not 35. And so it's a sense that, okay, we're oversold enough to maybe have a bottom, maybe not the bottom, but I think what's happening today and what probably will happen in the days ahead is that the market had to do a one-time adjustment to this new reality, right, of essentially, very like worst case scenario tariffs. And now that the market has done that, it's going to try to find its footing. And I'll just give you a couple more stats. So slide two shows that, one metric that I look at is the percentage of stocks above their 200-day moving average. That's at 23. Again, very oversold, but not like epically oversold, right? Like in 2022, we were down at 12%. And then slide three is the same one, but for the 50-day moving average. And again, there we are at, so the next slide, um, there we are at 13%. And again, very oversold. I mean, that means that 87% of the stocks are above their 50-day moving average. But at true oversold record extremes, you're almost down to zero, like we had in 2022 and in 2016. So we're oversold. Maybe as of today, when the numbers are updated, we'll be closer to those levels. But kind of that's where we are. And if I can use one parallel that I used last week, slide seven, again, the long-term capital management cycle in 1998 has very little in common with today. But it was an unwinding of very significantly leveraged trades in the bond market. And of course, the current cycle is an unwinding of a very concentrated market relying on the Mag 7. Again, a totally different story, but there are some similarities. But look at that price analog. And again, I don't want to over rely on price analogs, but this might actually be a good guide to what we might see, which is you have this very sudden repricing. Then you try to find its footing like we're doing right now. Market bounces around, waits for maybe, heads to roll in Washington. Maybe Howard Lutnick has to like fall on his sword or something, because someone has to pay, or maybe there's a rollback or something happens, or they announce all these new tariff deals, bilateral deals with individual countries. So some kind of damage control that allows the market to sort of settle in. And that doesn't mean we're going to rebound the way we did in late 98. I don't think that's likely because I don't think the Fed is going to be able to do today what the Greenspan Fed did back in late 98, which was to ease rates 3 times. And of course, then you had the whole tech bubble happen into 2000, and we've already had that. So many ways we're different this time, but the sense that you have this purge in the market, and then you have kind of this new price discovery happening at those levels, that I think is probably the next phase here.
I mean, that's interesting because that is there's a time lag there, but that is a bit of a dead cat bounce because it's traveling up and then it retests.
And there's one thing I've learned, and actually it's funny, last night I'm trying to fall asleep and
I'm sure you haven't slept much. We're very grateful for what you provided here.
But I was thinking like, okay, like how you count sheep as a lullaby when you try to fall asleep. I was counting all the bear markets I've been in my career, and I think it's been like 11 or 12.
Wow.
The 87 crash, the 1990 S&L crisis, 94 Greenspan, 98 LTCM, 2000 dot-com, 2007 housing, 2011 Eurozone debt crisis, and so on and so on. And I'm like, okay, the market does always come back. And every couple of years, we're down 20, 30%, right? Like 2018, we were down 20%, 2020 down 35, 2022 down 28. And guess what? The market does always recover, sometimes slowly, sometimes quickly. But what often happens, and the reason I'm telling you this story is like back to that 98 analog, that is a typical pattern where you have the impulse low, which is the volatility low. Then you have a bounce, you have kind of this price discovery, and then usually you have another attempt at the low, and either it's a new low, or like in 1998, it was a slight new low that was rejected, and that's what creates the kind of juicy breadth and sentiment divergences that us technicians will look for to give us a sense that, okay, this could be a bottom. And like in 2008, for instance, we saw that happen with the intermarket relationship. So in December of '08, if you remember, we had this big washout as the bond market completely seized up, right? And the Fed had to really step in. Um, Emerging markets, high yield, and stocks all made a low in December. Then you had a recovery, and then in March, the stock market made a lower low. That was the 666 low on the
That's
S&P.
right.
But emerging markets and high yield made a higher low. And that was one of those situations where, like, you have to kind of take a leap of faith, but those are the things you look for as a technical analyst for signs of a bottom. But we're still at the impulse low part, and maybe we have a giant V-shaped recovery. I don't think so, but so we're still at that impulse low, and then we probably have a few months to kind of find the final low, and maybe it's not much lower than what we're seeing today, or maybe it is. But I think that's typically how these things evolve.
That's absolutely fascinating. And that the indicators in that case that you were looking for was high yield and EM. At this stage, what might you look at as we see things perhaps try to create, as you say, a vol bottom and at least chill out a bit? What might you watch? Would it be small caps? Would it be new leadership in the equity market? What would that leadership be? What would you look for?
Yeah, it's a great question. I would say so. The Mag 7, of course, have been at the center of the storm, right? And we go to slide 28 here. Um, so let's say the Mag 7 makes a lower low, and the S&P equal weighted index does not. Like, it could be something like that on an interrelated market. Of course, the classic standbys that we always look for are those breadth numbers, right? The stocks above their 200-day moving average or 50-day moving average or 52-week lows. If the index makes a lower low, which it would if the Mag 7 are leading to the downside, and the rest of the market does not, that could be a tell, or it could be the opposite, right? Because the Mag 7 are driving the action down. And one thing with bear markets, if this is even a bear market, like it could be like a 2018 where you're down 20%, but then you recover quickly. And really, that wasn't a bear market, even though it was down 20%, but it was more like an outsized correction. So we don't know yet how this is going to pan out, but let's say this is a bear market. Let's say we have a recession because obviously we have a massive shock to the system in terms of trade. Then you look for signs where the decline starts with the overcrowded longs, which of course was the Mag 7, and it ends with the safe havens, right? That's one thing we learned from '08. And again, not to make a parallel to the financial crisis, because I don't think we're in a financial crisis at all. But what happened there was the places where people were hiding, like the quality stocks, even those got kind of bombed out at the end because the bear market doesn't leave you any place to hide. And so that could be a sign. If this ends up being a bear market, that could be like another sign. Another area I would point to is on slide 29. This is the MSCI All Country World ex-US. And so, of course, we all know this we've been in this period of US exceptionalism, US stocks outperforming the rest of the world, of course, driven by the Mag 7. The rest of the world, of course, has been sort of dead money for years, right? Like you see the absolute price level at the top there. It hasn't really done much, but as a result, it's also not going down much, right? It's down 8% from its high, which is, of course, a fraction of the rest of the US market. So the price action on this side would be very good to watch as well. And so it's always a mosaic approach. Credit is another area where I would look for, to give you a sense of where we are.
I mean, let's talk about credit because the spreads have finally spread out.
So if we look at slide 10, and I apologize if I'm rambling all over the place, but there's like hundreds and hundreds of charts that I have to
are, and
unpack
there's
over
lots
the-
of questions for you, so I'll get those in a minute. But let's do this first.
So here's investment grade credit spreads are widening, which makes sense, right? I mean, corporate bonds are a risk asset, just like equity. So it would be rare for corporate spreads to fall while the stock market is falling. And if we do get a recession of some sort, Again, not a given, but it's not certainly not implausible. You would expect credit spreads to widen, but then it's a question of do they widen more or less than they should, and is there a tell there? And so far, spreads are widening about 40 basis points, but they came from such a low level. The starting point was 110 basis points over Treasuries, which is a historic low. If we look at high yield on slide 11, it's a little bit more though. Spreads have widened from about 220-ish, so that's slide 11, to 294 to 468. So that's a more significant widening, which you would expect from high yield. But even that 468 is kind of not far from the historically normal levels, right? So
Interesting.
credit spreads have been extremely narrow for quite a while now, and so they're starting from a very low level. So again, this is a whole mosaic approach of many, many things that I would look for signs that the selling, which has been indiscriminate, which is another sign that this is a capitulation, that there are some green shoots happening, and that's why you can rely on me to look through thousands of indicators to see if there are green shoots and whether they will actually hold.
Absolutely fascinating. Okay, so let's get to a couple of these questions. They break down to, it's actually a number of currency questions, which is great. So one of them is de-dollarization, which you spoke to a bit last week, and the other is certainly sort of thoughts on USD CAD, expectations for the rest of the world. Let's go into the currency and what the dollar's been doing. You talked about safe havens. It was a bit of a shaky one for that.
Yeah, so this is really, I would say the most, I don't want to say disturbing thing, but the most odd thing about this whole cycle has been the behavior of the dollar. So if we go to slide 23, so historically speaking, when you have stress in the markets, the dollar usually goes up because the dollar is the world's funding currency. Not everyone funds in dollars, but many companies around the world do. And so when there is a scramble for liquidity, the dollar typically goes up. And what we're seeing here is that the dollar basically crashed over the last few weeks, even though the stock market fell as well. And so that brings me to the next slide, 24, which shows the correlation of the US dollar index to the S&P 500. That's the green. That's the 5-year correlation. And the black line there, just for the last couple of years, is the 52-week correlation. And then the purple area are the drawdowns in the S&P.
Right.
And so what happened was before the financial crisis in '08, there wasn't really much of a relationship. But since the financial crisis, whenever there's stress, which of course would cause risk markets to go down, the dollar would go up and therefore the correlation would go negative. What we're seeing now is that the correlation was deeply negative, 61% negative, just like a few months ago, and now it's 4% positive. So the dollar is weakening as the market is weakening, and you have to wonder whether that means that there is a larger secular sort of tectonic shift going on where a new structural regime is emerging about sort of the global world order.
Right.
And so just to kind of dial back the history here, of course, we used to be on a gold standard, right, where everyone was tied to the price of gold. Then in the late, then we went during World War II to the Bretton Woods Accord, where the dollar was basically tied to gold, and then all the other currencies were pegged to the dollar. That of course fell apart in the early 70s. That's when the fiat era began. And since then, we have what we call Bretton Woods Part 2, where basically the US is sending their dollars overseas either to buy oil or to buy consumer goods in China or what have you. And then those dollars end up recycling back into the US to buy our treasuries, to buy real estate, businesses, whatever it is. And so that's been kind of the new world order, really from the early 70s until now. And so if the Trump administration is trying to create a new world order where the supply chains come back to the US, where you have a manufacturing renaissance, where we're going to punish other countries for having unbalanced tariffs and all of that stuff. If this is not just the art of the deal, but really creating a new world order, then that would emphasize the deglobalization that's already been sort of underway for a little while, but also potentially de-dollarization, as the question was asked, where you get trading blocks. Hopefully, you guys are part of a North American trading bloc, but like China will have a trading bloc, and so the world becomes more insular and more fragmented, and then the dollar loses kind of that function. It'll still be a reserve currency, but it might decline in terms of how much of it will be. And if a trade war ends up being a capital war, right? Let's say China sells its treasuries or what have you, it's hard to see the dollar still being kind of the center of the action. So again, we don't really know if this is how it's going to be, but if this is truly a tectonic shift to a new world order where countries turn inward, there's less global trade, then that has a lot of repercussions, not only for interest rates, for currencies, but even the stock market leadership. And so, I was going down this rabbit hole over the weekend in my report, and I'm like, that's like a whole book. So let me save that one for next Sunday.
Okay.
So it is something that where I'm going to try to peel the onion more on this, but that's potentially significant, especially considering if we go to slide 25 for a second, where we are in the very mature phase of a secular bull market, right? So here in the gray is the secular bull market that started in 2009, and the orange and the blue are the two that preceded it. And so we're kind of in the like we've talked about, eighth inning, seventh inning.
Yeah.
We're in the twilight phase of that bull market, and of course that bull market was driven by U.S. stocks and by U.S. mega cap growth stocks, and disinflation, low interest rates. And so if that's all changing, then you really have to wonder whether the secular bull market is not ending, which doesn't mean you should sell all your stocks, but it does mean that era of double-digit returns centered around U.S. exceptionalism, whether that's coming to an end, which will create a lot of opportunities, especially for Canadian investors who have a currency decision to make. But that could be a really big change that should not be taken lightly.
So and as you say, more on that probably next week, because it's almost a book worthy. Question coming in here. This is, can the 60/40 portfolio hold its own going through this current environment?
So we've talked about this in the past. So I've already concluded that the old 60/40, our parent 60/40, is no longer really the benchmark, right? So certainly for a U.S.-based investor who has benefited from the U.S. exceptionalism, if you go back a couple of decades, really all an investor needed to own here was 60% S&P, 40% Bloomberg Barclays Ag, investment grade bonds. And anything you tried to do to outsmart that basically didn't yield much, right? If you went international, it detracted from your return. If you went into other like commodities, it detracted from your returns. So already for the last several years, I've been emphasizing kind of the new 60/40, which to me was really ushered in with COVID, right? When that structural inflation and interest rate pendulum started to swing, where the new 60/40 is more like a 50/20/30, the way I think of it, right? So still equities, but maybe more international, more value, less emphasis on U.S. growth, and still bonds, but I think bonds are going to remain somewhat challenged, right? We're at 4% today. I really don't see them going much lower than that. But you want to own some bonds. They are being negatively correlated right now, which is good, and they do provide a real yield, which is good. So there's definitely a place for bonds. But then you get into other stuff. I think gold, and I'm preaching to the choir here, speaking to Canadians, but gold has been a powerful anchor. We know what it's been doing lately, of course, but to me, gold are the anti-bonds, right? If you look at historical correlations, bonds generally work, and gold often doesn't work. But when gold does work, it works really well, and it does so at the times that bonds do not work.
Right.
And so to me, like, I'm not going to mention percentages, but having some gold in there as a diversification, not against stocks but against bonds, I think is a very interesting idea. And of course, I would throw Bitcoin in there, but commodities in general, tips, high yield, other kinds of like private markets, managed futures. So things that don't have a huge beta, think of it as like an absolute return type strategy, but they're uncorrelated to the stock market. And so that's how I see the new 60/40 working. And I think that kind of portfolio would work well if we are entering a new structural period. And there would be less emphasis on the beta and more on the alpha. So if we are really going to end the secular bull market, doesn't mean the market goes down. It just means you don't get those double-digit returns. And so you can't just rely on the beta of markets just, providing good returns, and it almost doesn't matter where in the market you're invested, you're going to get good returns. I think you would have to lower the expectation of the beta and play more of an alpha game where you get relative returns against a lower growth rate, not a negative growth rate, but a lower growth rate.
Okay, just sort of have to be settled in with that. Here's a question about the Fed. We only have a couple of minutes left. There's a lot to say there, but this question is, can the Federal Reserve save the nosediving markets? You might ask, would they? But anyway, what do you think?
Yeah, it's a great question, and I think my answer, the answer is not as much as we are used to, right? So think back, 2018, we had that 20% very sharp correction in the fourth quarter, and the Fed, of course, had been raising rates into that. That's what the market was responding to, and the Fed pivoted very, very powerfully. We had the Powell pivot in late 2018, early 19. And that, I think, was largely behind the market's very big recovery. Again, LTCM 1998, Greenspan came to the rescue there. So I think those types of responses are less likely because inflation is still close to 3%. And if we do get another inflation wave because of the tariffs, and again, who knows whether we will, but if we do, the Fed just can't go back to 0 or 1 or even 2% the way it might have done in the past. And of course, there's the political side as well, not to get into politics, but...
So, okay, you only have a minute to do it anyway,
yeah. So the Trump administration is clearly trying to push the Fed to lower rates. Like that's the new benchmark for Trump. It's not the S&P 500. They're willing to crash the stock market if it gets some lower rates. If you're Powell, are you going to play that game? Are you going to just be so transparent that you're going to respond to kind of that? So I think Powell, and he said this on Friday, he said, we're not going to get more dovish here until we see inflation come down. So I don't think we're going to get that Fed put, or we may get it, but the strike price is further out of the money than it has in the past.
Okay, fantastic. We could leave it there. There is one more that I think I might be able to sneak in here. Let's see. This is talking about politics a little bit. Can the President of the United States implement all these tariffs without Congress or Senate? What is they're sort of getting into what's the point? But I mean, he has
a lot of power to do tariffs. That is one of the areas where the president does not need a lot of legislation, but he's using very obscure language in trade agreements and other laws to justify these. So I would say it's more likely that tariffs get challenged in the courts than in Congress. And of course, presidents always do that. Obama did the same thing. He would use extremely obscure one sentence in a 100-year-old bill and say, this is why we're doing this. So I don't want to put this on Trump entirely. Everyone does this. But so he can do a lot here, but I'm sure there will be challenges in court, either a world court of some sort or even a U.S. court.
Okay. Jurrien Timmer, we're so grateful taking us through, what possibly is happening right now and what possibly it portends in the future. Thank you for joining us, and get some sleep and have a good week.
Thank you.
See you soon.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.